prices must go up by 2% every year. And if they don't, well, this is a huge problem. And the central banks need to solve this problem with radical monetary policies. Even if it meant negative interest rates, they would do that in order to make sure that the cost of living went up by 2% per year. Now, to average people, this would sound absurd. Everybody likes it when the things that they want to buy, the things that they need to buy, become more affordable. So why was it a problem for the central banks that the stuff we needed to buy wasn't going up in price fast enough and it needed to rise faster? The central bankers were faced with some serious economic problems that they didn't want politicians to have to deal with. Countries had run up a lot of debt, and the governments really didn't have the ability to pay all this debt. And so what central banks did was lower interest rates to make that debt affordable by lowering the interest payments on that debt. And that allowed governments all over Europe, governments in the United States, to continue to pile on debt without having to make any difficult political choices of raising taxes or cutting spending. But also, because central banks kept interest rates so low, it wasn't just government debtors that were able to go deeper into debt. It was the private sector. Corporations, individuals, everybody loaded up with debt. And the more debt everybody took on, the more the Federal Reserve and other central banks felt compelled to keep interest rates artificially low, because allowing interest rates to rise would have caused a financial crisis. A lot of people would have defaulted on their debts, including governments. And so the central banks kept interest rates low and kept printing money. Now, they called it quantitative easing, but quantitative easing is basically a euphemism for inflation. That's what it is. When the Federal Reserve launched quantitative easing for the first time in 2009, what it really decided to do was monetize government debt and create inflation. That's what quantitative easing was all about. It was about inflation. And in fact, the central banks justified quantitative easing and negative 0% interest rates because they said these policies were necessary to raise the inflation rate. Inflation was too low. So central banks recognize that these policies were in fact inflationary because they were designed to cure the problem of too low inflation. But that problem didn't exist. All they did was pour gasoline on an inflation fire. Now, inflation didn't really rear its ugly head in a way that became a big problem until last year. And that's because these monetary policies operate with a lag. And what surprised me was the length of that lag. The inflation that we're experiencing now in 2022 really started in 2009, 2010. So the prices that were impacted the most by inflation were stock prices, bond prices, real estate prices. And so people didn't mind when inflation was making them richer. In fact, people like that. Politicians like that. Everybody likes a bull market. So when inflation is first entering the economy and the first impact it has is on asset prices, nobody's worried about it. And so the central bankers kept creating it. The other factor that was important was the fraudulent way that governments measure inflation, particularly here in the United States. I'm more familiar with our CPI, but I think other CPIs in other countries are similarly flawed by design. But the increase in consumer prices, the way it's officially measured, is not nearly as great as what is actually experienced by consumers when they're buying goods and services. So if you have an official measure of inflation that says prices are going up by 1.5% a year, it's possible they're going up by 4 or 5% a year in reality. And so when the government says, hey, we don't have enough inflation, we got to get that 1.5% inflation up to 2%, what they're actually doing is getting that 5 or 6% inflation rate up to 10%. Now, where we are today, you've got nations all around the world reporting official inflation rates at 8%, 9%, 10% or more, which means the unofficial actual rate of inflation is probably somewhere between 50 and 20%. Bonds are woefully mispriced. Yields need to be much higher. Prices need to be much lower. Stocks are overpriced. Their multiples are too high. The US dollar is dramatically overpriced because it's going to lose a tremendous amount of its purchasing power over time, and therefore it should have a much lower exchange rate than the one it has right now. It also means that gold and silver prices are much too low because right now gold is priced for a world where there is no inflation, where inflation has been vanquished by a tough Federal Reserve that is committed to ridding the economy of inflation. When the markets realize that that's not the case, that the Fed is going to choose inflation as the lesser evil, because that's the choice. Do we have a massive economic collapse, financial crisis, depression, waves of defaults and bankruptcies, or do we tolerate higher inflation? The Fed already made that deal with the devil, and it's going to keep its commitments. We're going to have higher inflation. The markets just need to come to terms with that and price it into assets. And of course, it also means a huge decline in the American standard of living, because I think the recognition of this reality is going to be the final nail in the dollar's coffin. It's going to cause it to lose its status as the world's reserve currency. And so Americans are not going to be able to exchange the money that we print for the goods everybody else produces. The bubble has grown much larger during the years of can kicking. And as a result, the collapse is much greater. It means that investors stand to lose a lot more purchasing power if they don't understand what's going to happen and modify their portfolios to account for this. And it also means that the investors who do make those changes are going to make even greater profits, I believe, as a result, because the bigger the bubble, the more air there is to come out. And the more air that comes out of the bubble, I think the more profits that the people make who bet against that bubble. And so that's what we're doing at Euro Pacific Asset Management with our strategies. But I think for people who want to speculate and who are willing to assume a higher degree of risk, and that's always the case when you're investing in gold and silver mining companies, I think those assets are among the most mispriced assets in the market, because if inflation drives the price of gold up to 5,000 or 10,000, the markets currently assume that the price of gold is going to stay at 1,800 or lower into the indefinite future. I think the markets are wrong. But more importantly, not only will a much higher price of gold relative to the cost of mining it really help earnings of these gold mining companies, but it's going to cause a lot of gold that markets currently assign a zero value to all of a sudden have incredible value. Because if a gold mining company has gold and it costs $2,000 to get that gold out of the ground, and you don't think the price is going above 1,800, that gold is worthless. It costs more to mine it than you can get by selling it. But that whole dynamic changes. What if the price of gold goes up to 5,000 and the cost of mining it goes up to 3,000? Now you have $2,000 value for every ounce in the ground. And now that value is now going to be factored in to the price of these stocks. So I think you have tremendous opportunity in that segment of the market. And I believe that when the dollar finally tanks on this reality, that is going to set off an economic boom outside the United States, particularly in the emerging markets, because those economies have suffered from an overvalued dollar. They are going to experience relief when the dollar is no longer overvalued. And in fact, I think there's going to be big inflows of capital into these economies that is really going to provide a big boost to their economy and therefore provide a significant increase to the asset values in those economies. I actually do have an emerging market fund that people can invest in specifically to take advantage of the repricing of emerging market assets, not just the stocks, but the currencies that those stocks are denominated in. Because as the US dollar falls, I think it's the currencies of those countries that are going to rise.